So we're here today to talk A to Z of leverage buyouts, the 101. So It all starts with sourcing deals. Where do we find the deals?
Yep, I think sourcing and deal flow is the most important, especially when you're starting out, because if you don't have that, then there's no real deals to play around with. You can't really analyze companies, you can't learn from analyzing different companies and so on. So deal flow and sourcing deals is the most important part. There's two main ways in which you'll start finding deals. One of them is on market, so companies that are already engaged in kind of corporate financier, broker, advisory company that is helping them sell the business. I would say stay as far away from those guys as possible if you're going to do deals our way. But if you are going to deal with them, and we have bought companies through advisors, you want to make sure that you set the expectations outright from the start. So how are we going to structure deals? What's the valuation process like for us? How do we like to engage and work with the business owners on the acquisition front? And once you set that process up and you've set that expectation, then I would say working with brokers and corporate financiers does to get it a lot easier. But make sure you do that. And then obviously there's the off-market area, which is a lot more interesting because you can have direct relationships with the sellers. You can talk to them without having set an expectations up front as to what they want, what you want out of a deal, and you can start the relationship building process. These guys you'll probably find through different online data sources. So in the UK there's softwares like Endo that allows you to access financial information of these businesses online. In Australia, in the USA, in Canada, in the Eastern Europe, there's different databases that will allow you to have rough ranges in terms of the revenues, the industries, the employee size. There's the likes of ZoomInfo, Seamless, Apollo. There's a lot of them out there. Make sure first of all that you create a list of potential candidates based on the criteria that you want. You get their email, phone number, and home or business address, and then from there you can start contacting them via letters, via email, and via phone calls or WhatsApp if that's something that you are willing to do. So I would say contact directly to the seller, start building a relationship with them, and then start engaging from there.
Yeah, and so if you wanted to roll up in the recruitment space, you could go into endol.co.uk, you could pull up recruitment businesses that matched a certain financial profile, and you could target those businesses. We tend to target a lot of the baby boomer generation that are perhaps at retirement or near retirement age, so they're more likely to be exploring an exit strategy, and we'll connect with those people. So you mentioned that we can do direct mail, we can do LinkedIn, we can do email, and all of those medias can be used to connect with business owners. So when you've marketed to them, you've got them on the phone, they've responded to your letter or email or whatever, however you've contacted them. What are the sort of things that you say in that first call, that first introduction to the business owner?
So it's a sales process, right? So instead of just focusing on the transaction and being a bit cold about the fact that you're going to negotiate them down in the price, or you're going to try and do something strange with the business, you want to start with the relationship. So what I would say, first thing, you want to build something in common. So if they're in an office, you can start talking about their office or their background or the weather or the typical thing that you talk about in the lift, so that you can just break the ice essentially to start with. Once you've got that relationship starting to uncover and you've got something in common and so on, at that point I would ask for permission to provide information about myself and what our company does for the company. Obviously we're an acquisition company, so I would talk about the fact that we've bought more than 90 companies, we've got this track record in these industries, we're looking to buy in their industry because we see the fragmented opportunity of building a group inside their industry. We want to try and collaborate with the management team, bring in opportunity for within, build upon the brand that's already been built, and then look at building up the revenue through inorganic growth and organic growth. So that's kind of like what we're trying to do inside the industry. I'll focus on talking through that, and then I want to understand where they're at in their business life cycle. So like, are they looking to grow still? Are they looking to exit right now? And I want to understand what their personal motivations are towards that, on that area, on the business life cycle. And, once I understand what the motivations are, I'll ask further questions so that I can uncover really what's really down there. if they're looking to exit, at that point, I'll talk about, how we value businesses. So, I'll talk about the fact that we do leverage buyouts. We're looking to buy 100% of the shares. How we structure the acquisition. So we look at the net assets on the balance sheet. We look at the EBITDA on the P&L. We add a multiple to the goodwill of the EBITDA, and then roughly, the valuation tends to come at, say, between 5 to 7 times multiple of EBITDA, with the net assets included on that scenario. And there's an amount that comes up front on day one. There's an amount that comes on a deferred basis, and we kind of want to start creating the expectation as to how we're going to structure the acquisition, where the financing is going to come from, what the terms are going to look like, and then I want to get their feedback from there. Once you get the feedback, you'll kind of understand where they're at mentally and emotionally in the business life cycle. And from the next stages would be to get an NDA signed and run into the financials. So what's your thought process on the NDAs, Paul?
Yes, so those first calls probably take 30 to 40 minutes, and it's, as you say, very much about rapport building. It's probably them speaking more to you about their business, where they're at with it, why they're looking to explore an exit. Is it retirement? Have they got something else? Has something else changed in their life? Trying to understand those motivations. And the reason why we get into the conversations around valuation in that first call, which might seem a little bit too soon for some people, but the reason we do that is so that we set the expectations. That look, if a business owner has got really high expectations on value that we know we're not going to be able to meet, well, it saves having a second, third, fourth meeting before you discover that. So it's really a sort of rapport building, sales exercise, setting expectations. And what we say on that first call as a sort of close is the next step is to solicit some financial information. So let's get an NDA in place that protects both parties. You're going to share confidential information with me and vice versa. And we get those financial statements, which is usually three to 5 years, full set of accounts, recent management accounts. And then we talk to them about, we're going to go away and analyse that and then come back to them with that sort of ballpark offer or ballpark ideas on valuation and structure, so that we almost take it away from them and say, look, if that works for you, then we'll invest the time to get to know you and put a deal together that works. But equally, if we're not on the same page, well, we've wasted 30 minutes of our time. It's no hard feelings, and you sort of move on to the next one.
Yeah, and we can always revisit at some point in the future if we're not aligned right now. Maybe in 2 or 3 years' time we are. We actually had an example this week where I talked to a seller about 3 years ago. Now he had some pretty high expectations. He had a lot of buyers, so it was not a good buying position for ourselves. But nothing happened there. And then 3 years later, he's come back to us because we were building the relationship at that point in time, and now he wants to do a deal with us. And say when we receive the financial information from the seller, what kind of adjustments can we make in the balance sheet and the P&L? What do we tend to look into when we analyse the
Yes, so I go back to, ultimately a business is worth what a willing buyer and a willing seller are prepared to trade at. The way we do it is we apply a multiple to EBITDA, and we add the net assets that we're going to acquire. So what assets and liabilities are required on closing. And typically we pay a percentage of that up front, and then a percentage of that is deferred or on some sort of earn-out structure. So when we're analysing the figures, what we're looking at is ultimately what we would call the normalised EBITDA. So it's not uncommon to find in a business that they might be running expenses through the business that actually, as new owners, we wouldn't incur. Maybe their wife is on the payroll. Maybe they're running some private health insurance scheme through the books. Maybe they've got cars for their kids on the books that once we become the new owners, obviously all of those things aren't going to continue. So we could add back those costs to the EBITDA, which effectively would push it up. So we're basing it on a higher multiple than a higher profit than what the actual accounts might show. But we're also normalising it that, look, if the owner is taking some money out of the business and is going to leave, then obviously we can add that back. But equally, if we're going to need a new managing director to take over from them, then obviously that costs money. So that should be adjusted for as well. And it's very similar with the balance sheet. Typically from our point of view, intangible assets, intellectual property, whilst it might have value to the business, doesn't really have value to us as from a funding perspective. So typically we tend to adjust the balance sheet for IP. And then if there are any assets that are going to be removed, maybe they're going to keep the premises and rent it back to us, or maybe they're going to keep some motor vehicles or whatever they decide, we can adjust the balance sheet accordingly. And that's all of the sort of analysis that we do, so that we can come up with that sort of ballpark offer. And we also analyse the balance sheet so we can understand what sort of funding is available to that particular opportunity, which is really where, you know, we're working out what we can pay them as an initial consideration, from the leverage or surplus cash if it's a UK deal, for example, and then obviously what the deferred period is going to be like. So we're looking at, you know, what is the free cash flow in the business, how much of that do we need to service the debt that we're going to be injecting into the balance sheet, and what's affordable and what's viable. So it's a fairly detailed analysis, but I guess when we're talking to a business owner, we can actually share that analysis with them and present it so that it's not just a figure that's been plucked out of thin air. There is actually some logic to it. So, you know, if you have got a business owner that maybe wants a higher valuation or more consideration up front, you can justify by using your analysis by saying, well, look, this is affordable, that's not, this is fair, that's not, and then ensues a negotiation.
And that's why you want to listen as well to the business owners. So sometimes they're looking to retire and they want to have some kind of pension scheme going on, and they've got a real estate piece, right, or real estate. I know this happened with UK salads, where the family owned the premises, so they own the commercial property. They wanted to have some kind of long-term payment plan for themselves in order to retire properly. So you take the property out of the, you know, of the split. So you do a property split, and then you can rent out over a long-term lease, you know, from the business to the property owners, which would be themselves, and they create passive income that way. I think the same can happen with the IP as well. So if they've got some kind of IP that is really important for the business to run, you can create a licensee model where you can rent out the IP of them and utilize in order to provide passive income for the owner, and then obviously you can take over the business.
Yep, so, absolutely.
Sounds good. And then what about in terms of making an offer on our end? We've got a process, I think, that is really good because we're able to be really efficient with business owners, so we don't really waste that much time from them. We don't waste time on our end, and we want to make sure that, you know, the business owners that are looking to transact right now, we're able to provide that for them. We normally present the offer, you know, on day one. We tend to look at what we can afford up front, which tends to be between 30 to 60% of the purchase price. Deferred basis tends to be between 2 to 5 years over, you know, a fixed period of time. This tends to be on a quarterly, bi-yearly or yearly basis, and we try and make sure that that's affordable for the business. So we look at, you know, the debt serviceability. So normally if the business is making, say, 1 million in profit, then the interest payments on the debt plus the deferred, we don't really want that to be above half a million, right? And this allows us to, you know, make offers that are affordable for the business, for the long-term financial well-being of the business, and, you know, for the banks to lend us money. What's your view on how we make ballpark proposals and not formal offers up front? Why do we do that, Paul?
Yeah, so it's really to save time and set expectations. So typically we tend to have 1 or 2 calls with the business owner to build the relationship, build the rapport, set the expectation. We're getting the NDA in place, we're getting the financial information so we can make an analysis of that. And then we go back to them and we say, look, we can give you a ballpark idea of, look, if we're going to do a deal, this is roughly what it looks like. This is a valuation. This is how much is payable at closing. This is what the deferred period is. This is what the earn-out structure is. And it's not a formal offer, but it's basically saying, you know, if we're going to do a deal, it's probably going to look like this. So if that meets your expectations and we're on the same page, then let's invest the time to really get into the detail of the business, understand the business, get behind the numbers so that we can form a formal proposal and an offer and sort of move to a heads of terms. But equally, there's no point any of us wasting our time and investing in that process if we were never on the same page in the first place. And I actually find that acts as a really good filter. When I was looking to roll up in the training industry back in, I think it was 2017, I drove all around the UK. I was in Scotland, I was on the South Coast, I was in London, and I met 28 training companies in one particular month. I didn't close any single deal. And I think the reason for that was their expectations weren't set at the beginning and their expectations were too high. Where if I'd gone and had those virtual meetings and presented those ballpark ideas on valuation with those 28 companies, I would have saved myself a whole month of driving around the UK and living out of a hotel room. And that's really why we do it this way, and it works for us.
Yeah, especially with COVID, people have gotten used to working online and having that virtual meeting to begin with. So I think if you move along, you know, the deal making process, and obviously you're going to buy the business, you you'd rather have like an in-person meeting, right? But if not, first calls tend to be really good for online meetings and virtual
Yeah, I
meetings.
mean, do we meet business owners?
So in an ideal scenario, we would love to, but obviously we're busy people, business owners are busy people, and we can take calls from wherever we want right now. So, you're living in Greece, I'm living in Spain. Most of the businesses that we've bought are neither in Greece or in Spain. So
Absolutely, yep.
what you want to do as a deal maker is you want to work from the shareholder perspective, and you want to make sure that you build an operational and executive team that when you buy the business, you're able to send these people and your people out into the battlefield, so that they can work around with the business owners.
Yeah, I mean, if we don't actually get involved in the day-to-day runnings of the business, we're here to facilitate the deal, make it happen, find it, make it happen, and then hand it over to an experienced team who are going to be far better than us at running those businesses. If you take Aquila Food Group, which is a roll-up of businesses in the sort of food space, the executive team's got over 100 years experience working at board level with some major blue chip food businesses. What they don't know about running food businesses probably isn't worth knowing. So they might be the people that go out and visit the business owner before the deal's done, or certainly straight after the deal is done. But because they can talk their language, they understand the business, they understand the challenges, they understand the opportunity for growth. And whilst we might have an understanding of that, we're never going to be as good as someone that's got 40 years sharing food companies or 30 years running fresh produce businesses. So
it comes down to, Richard Branson, right, one of the most successful entrepreneurs in the UK. I'm pretty sure he doesn't know that much about space. In fact, I heard an interview with him where he didn't really know how to even read a P&L. Mm-hmm. So that gives you the perspective of really you need to surround yourself with people that are cleverer than you, or cleverer than you.
He doesn't fly the spaceships to space, does he?
Exactly,
He probably hires the best astronauts from NASA or whoever to do that.
Yeah. So I think when you become a real business owner is when you start delegating, and that's one of the areas that you can start delegating. And as part of being a deal maker, that's what you can start doing. And then, okay, so let's say you presented the offer, you presented the ballpark, expectation is right, you've set the terms upfront, deferred, fixed deferred, these are the conditions, the securities, etc., etc. And the deal is tied up, okay? So now it's time to present the heads of terms. What happens then? What happens when you've got it?
Yes, so the heads of terms, that's a sort of term that we use with UK companies. In the US, it tends to be referred to as an LOI, letter of intent. And effectively, I call it the roadmap of, these are the basic terms of the deal that we're trying to put together. It's the roadmap that we give to the lawyers, and then they use that to construct a contract that everybody's happy to sign with those core terms. So it's a non-binding agreement in the main. So, it's not binding the parties, but I do think it acts as the glue, so that if there are any issues later down the track in negotiating the deal or changing things, we can always refer back to the heads of terms and say, well, look, all we're trying to do is put the deal together based on what we agreed in those original heads of terms. So typically you'll see, the name of the owner, the name of the company, who owns the shares. You'll then have the deal structure. So what's the initial consideration? What's the deferred? What's the earn out? How long is that period of time? And then there'll be some, customary core terms. So the deal is going to be subject to warranties that we're going to rely upon to do the transaction. So there'll be a very brief summary of what those warranties typically are, what the time limits for claims are, what the amount of a particular claim could potentially be. If the owner's going to stay on, there's usually some mention there about the consultancy agreement for them and how long they're going to be involved in a handover. Is it 6 months, 12 months, whatever? And then the binding parts are the confidentiality clause, which is a bit like an NDA really. It's saying, we're not going to share any of the information between us, other than between ourselves and our professional advisors, and that we'll all, we're going to incur costs as part of this process. So we'll cover our costs, they cover theirs. Obviously, they.
So thanks for tuning into the Buy, Build, Sell podcast. Please visit buybuildsell.net in order to access our free community on buying and selling and building businesses, so that you can access like-minded entrepreneurs, get access to free resources, and be able to access content that is not available online that will help you on the deal making journey. We promise not to spam you, and we will be sending you the next episode on your email for free at your disclosure. Thanks a lot.
could potentially be at risk from incurring a bill from their professional advisors, even if the deal doesn't happen. So we just make them aware of all of that. It's a 3 to 4 page document. We present it to the business owner, we sign it, and we use that then as a roadmap. But we also have an appendix to that which sort of states the key milestones. So when are we going to aim to have due diligence done by? When are we going to issue a draft contract? When are we going to have the funding in place? And normally we sort of try and set those timescales over a 3 to 4 month period. Part of that is depending on how many deals we've got and we're managing at a particular time, and part of that is how quick and proactive the business owner is going to be at providing us with information. So we sort of work out those key milestones. But I do believe that time kills deals, and the longer we procrastinate over a transaction, the more chance there is of it falling through. So typically we like to work through that process over a 3 month period if we can. Sometimes it takes a bit longer. I think the quickest I've ever done it is 4 weeks, but that's quite unusual.
Plus the heads of terms gives you exclusivity of the deal, right? So like when you...
Yeah, good point. So yeah, we normally ask for a period of exclusivity. There's a lot of time and effort that goes into putting these transactions together. We're going to do the due diligence, we're going to invest in lawyers, we're going to do some fairly extensive financial modelling. And what we don't want to happen is that business owner to go off and sell it to somebody else while we're doing all of that work. So we ask for a period of exclusivity, usually that's 3 months, 6 months, something like that. And basically during that time, they agree not to negotiate with anybody else, gives us a fair crack of the whip, if you like, to do all of the stuff to assess whether we want to buy the business, and if we do, make the transaction happen.
Yeah. I think as part of going through the warranties and the disclaimers that will come later down the line with the share and purchase agreements and so on, there's a level of due diligence that we run through when we look at buying into the business. So the typical things that we look at are the financial components of the business. So do the numbers stack up to what they're telling us that they are, right? So we want to understand that pretty detailed, in like a pretty detailed way. We want to look into the legal aspects of it. So have there been any lawsuits? Have there been any, red flags in terms of the legal track record of the company? And then we also want to look at the operational aspects of it. So, employment contracts with suppliers, distributors, with, manufacturers, that kind of thing is, we want to look into the operational, financial and legal aspects of the business, and we want to run through a due diligence process on that front. This tends to take in between 1 to 2 weeks on our end, depending on how quick they're able to send over the due diligence papers. But, we do this internally right now, and it's working for us so far. Any inputs on that front?
Yeah, a lot of people think that due diligence is used by the buyer to chip the price. You go in, you look under the bonnet, you find out a load of stuff that you're not happy about, and you use that to renegotiate the price. We don't do that. Yes, if we found something fundamental, it's probably more likely to put us off doing the deal in its entirety rather than trying to reduce the purchase price. But I can't think of a time when we've sort of tried to chip the price because we've found something in due diligence. Generally, it's been that we've actually walked away from the transaction. Doesn't happen very often because we do a lot of the stuff up front before we even sign the heads of terms, so we can all get comfortable that the business is what we think it's going to be. And there are some jurisdictions like the UK where there's quite a lot of stuff that's out there in the public domain anyway. If you're a business on our radar, you've probably got audited accounts. So the fact that you've got audited accounts and auditors being prepared to sign off your processes and your accounts, then that gives us maybe a degree of confidence that what's in those accounts is probably there or thereabouts. So really it's for us to assess the business, see what the opportunities are, see how we're going to grow it, and get comfortable with it.
Yeah. And then what kind of legal documents? So we've got the heads of terms signed, we've got the due diligence process going on, we're starting to arrange, the financial projections for the business in order to present this to the banks. Okay. What kind of legal documents are required in order to make a transaction happen?
Yeah, so it's pretty standard regardless of the country that you're doing a deal in. So generally there's a share purchase agreement. So you're going to buy the shares of a business in America. In the US they refer to shares as stock, so it's a stock purchase agreement. And then there's a load of ancillary documents that typically go with that. So board minutes saying that you approve the transaction as a buyer, same from the seller. In the UK there'll be a stock transfer form that is a formal document that is stamped by the HMRC, the tax authority in the UK, to verify the transaction and that stamp duty has been paid. That tends to happen after the deal is done, but it's prepared as part of the legal paperwork. If the seller is staying on in employment or on a consultancy basis, then there's going to be some sort of paperwork between the seller and the company, sort of talking about how long they're going to be involved, what hours are going to work, what they're going to get paid for all of that. So they tend to be the typical suite of legal documents that tend to be as part of a transaction. Sometimes you'll get an asset purchase agreement. So if you're not buying the shares of the business, you're just buying the assets, the goodwill. Then very similar type of document, but it's structured in a way that you're buying the assets, not the shares. But from our perspective, probably 99% of the time we're doing a share purchase because we want to buy the longevity of the business. If we're buying a long established, well-run business, we want to benefit from that 10, 20, 30, 40 years worth of trading history. So we will always generally buy the company, not do an asset purchase.
And normally we like to buy 100% of businesses, and the directors will have to resign us from the directors. So there's a directors resignation form as well that we tend to fill in. And then, so we've got the legal documents prepared. We're now looking to raise the funding. What goes next?
So yeah, funding is obviously the crucial part. So typically we tend to kick off the funding process once we've signed the heads of terms. So we will have probably sounded out our typical funders and financiers to say, look, we've got this deal, this is probably what it looks like. Have you got an appetite for it? To really, I suppose, just sanity check that we think we can do the deal. Once the heads of terms are signed, we'll go and talk to our financiers and we'll raise the funding. So that's really a process of, writing a pretty detailed business plan. It's, sharing the due diligence with the lenders. It's doing all of the sort of really detailed financial modelling. Typically that tends to be a 5-year detailed cash flow, balance sheet and P&L sort of forecast, and all of that sort of information is then presented to lenders, and we're looking to generally leverage the assets of the business. So depending on the assets, there might be some further due diligence to do. So they might want to do a finance audit if we're raising invoice finance to check that they've got credit control processes in place, so that if it's going to have invoice finance, the lender can be comfortable it's going to be managed correctly. If it's real estate, they might want to look at the title of the property. They might want to have a survey and valuation report commissioned on behalf of the bank. If it's plant and machinery that we're leveraging against, then again, they're going to want to have a professional valuation done so that they can be comfortable with all of that. So that is quite an extensive process. It can be quite time consuming, but yeah, we're sort of running that concurrently with the due diligence and with the legals. So normally by the time that we've issued legals and we're sort of progressing with that, we've probably got 2 or 3 offers from funders that we're comfortable with, and then it's really a case of negotiating with those lenders to get the best possible terms that we can, and then we then try and move towards a completion as quickly as we can thereafter.
I think what also helps is having the track record of having bought lots of businesses and working with people that know you. So like there's a reputation that's been built with high street banks, with boutique banks that like to lend to us because of the professionalism that we tend to utilize in the process, in the track record, in the business that have been bought and so on. So that really helps out. And then, so you've now raised the funding. I know, the first couple of deals you signed a personal guarantee, right? What was your experience with signing a personal guarantee? And would you advise against it, for it? What's your thoughts on that?
Yeah, so it's not uncommon for a lender to, even an experienced operator like us that have done almost 100 deals, most lenders will always ask for a personal guarantee, particularly if you're not investing any of your own money into the deal and it's purely a leveraged transaction. They want to see some skin in the game. So either that's you putting some of your own money at risk, if you like, into the deal, or you're going to put yourself up as a sort of personal guarantor to the deal. So in the event that you default, I guess the lender's got somewhere to go. For me, we don't sign PGs. We're comfortable with our track record, our credibility, our business plan, and it's really down to the lenders to either accept that or we won't work with them. It's as simple as that. There are certain countries where you can get insurance against personal guarantees, but if you want my own personal opinion of them, they're not really worth the paper they're written on. There's an insurer in the UK that will insure between 60 and 80% of the PG, but in the event that you're going to default, you have to engage them, you have to talk to them. If you're going to follow an insolvency process, you've got to follow it with them, with their professional advisors. So effectively, it really just becomes, almost not worth the paper it's written on, because you're you're probably actually not wanting an insolvency event. You're going to want to avoid all of that. So the lender's going to have their own agenda, you're going to have yours, and there can be a clash. So really it's don't sign PGs. The whole reason of using a limited liability company is to limit your liability to the investment that you made as a shareholder. If you provide a PG, all you're doing is piercing that corporate veil so that the lender can come after you. So, you know, touch wood, we've never had an issue with any businesses failing. But obviously it is a risk, but everybody's got to be comfortable with risk. And at the end of the day, if we're leveraging against assets, the lender, to be honest, is secured, because in the event of an oblivion event, you know, if it's debtor finance, well, they collect the money in off the debtors and they're okay. If it's real estate, we've not leveraged it to 100%. There's still equity in the property, so they can sell the property and recoup what they're owed. If it's plant and machinery, very similar. So generally the lenders are protected because they've got security against an asset that is usually worth a lot more than what you've actually borrowed.
Yep. And then what, so once, you know, we've arranged financing, we've done the legals, due diligence, everything's ready to go, expectations are set, day one, closing, money's transferred to the bank account of the business owner. Obviously, he's going to have to deal with all the tax, all those, you know, government type issues that come as part of selling the business. You can go into Entrepreneurs Relief Scheme, which is called another name now.
Yeah, so it used to be Entrepreneurs Relief in the UK. It's called Business Asset Disposal Relief. So there's a certain criteria to qualify for it, but if you qualify for it, and most business owners that we're typically working with generally will, they pay 10% on the first million that they received and then 20% thereafter. Other countries don't necessarily have that, and you know, I mean, tax is tax at the end of the day, but we will always work with business owners and their professional advisors to try and structure the deal in the most tax efficient way as possible.
Yep. And then what? So once we've, you know, covered all the legal, financial, due diligence requirements, day one on the acquisitions, what do we tend to do? Do we meet the business owner himself? Do we meet the management team? How's our process on that front?
Yeah, so almost completion day is a bit of an anticlimax, because it's really, you know, the lawyers are swapping some papers that we've signed, monies are transferred. So typically, you know, that tends to happen around lunchtime, very similar to buying a property. And then what we do is we go in and we meet the staff. So our executive team will go in first one or second day maybe, and they'll meet the staff and they'll talk to them and understand the business. And it's really a message of reassurance. A lot of people think that you know, when there's a change of ownership, they're going to lose the job, there's going to be a lot of uncertainty, and we want to try and reassure people, because actually that's not our agenda at all. We want to buy a business and build upon it. So if anything, there's going to be more vacancies, more job opportunities for people, not less. So staff are the first port of call, and then it's about getting involved with all of the key stakeholders. So meeting customers, reassuring them, people in the supply chain, you know, if there's any other key stakeholders like funders, landlords of premises, all of those sorts of things, we're having conversations with them to introduce ourselves and reassure them that, you know, business as usual, still the same company name, we're not changing that, still the same people running the business, we're not changing that, still the same processes, still the same intent that we want to, you know, work with that supplier or work with that customer. And yeah, then it's about formulating a business plan and you know, how we're going to grow that business, working with the people within the business to achieve that.
And with staff on day one, would you advise on grouping everyone together? So maybe the 50 staff that you've got there, having like a group chat, a one-on-one chat, having both, having a group and then a one-on-one?
Yeah, so you know, if all of the staff are based in one set of premises, then it's fairly straightforward to whoever's working that day, everybody comes together. And if there's people away on holiday or absent for whatever reason, you know, generally we type up a communication that we hand out to people, and then if anybody's not present, they are you know, issued with an email or a flyer explaining what's happened and you know, to be reassured. And you know, then they will always have a one-on-one discussion with one of the senior executives of the business as and when they return to business.
Yeah. And then we like to, most of the deals that we've done over the past few years have been with joint venture partners. So people that wanted to do the first deal, wanted to build a group inside the industry. There's so many components to making a deal and so many skill sets that it helps when you've got a partner that has gone through the process lots of times, right? I know we started working together on a joint venture basis where we started feeling each other. We got a feel for how you work, how we worked, and you know, we like to work each other. And from everything evolved. Most of the groups that you will see online and that we're building have come through that process. And it comes down to, you know, making sure that your skill sets are aligned with what our skill sets are, and then from there building a partnership that is able to make us both, happy and successful on the deal making journey at the end of the day.
Yeah, I sort of say when you get into business with someone like a joint venture, it's a bit like a marriage, and fortunately marriages sometimes end in divorce. So it's really important the people that we're going to work with are like-minded, they share the same ethics as us, they understand the vision in terms of what we're trying to create. Someone that wants to buy a business and own it for 30 years isn't going to be the right joint venture partner for us, because that's not our model. We buy, we build, we sell, and typically we do that over a sort of 3 to 5 year period. And it's about working with joint venture partners that are either going to complement our skill set or add values in different ways. So maybe they can find the deal, we'll then do the deal. Maybe they've got more operational experience in a particular industry, so maybe once we've done the deal, they might take over the sort of day-to-day running or chairmanship of the business. So it's all about trying to understand those sort of value add components, really. Probably a good example of that would be Aquila Food Group that we're building. So I was contacted by a chap called Mark. Mark has an extensive history in the food space, saw a big opportunity to roll up in the sector, hadn't done a massive amount of mergers and acquisitions, and sort of his industry experience complemented with our merger and acquisitions experience joined together was quite powerful. So it took us 6 months to land our platform business, which was a fresh produce business. We sell, cucumbers, lettuces, tomatoes into mainly the European supermarkets. And then we bought a competitor, so we bought more market share. And 2 years later, almost, we've now done 4 acquisitions, and the group has gone from sort of almost 50 million revenue to over 100 million, and we've done that in 2 years in a very successful joint venture way. And we've got plans to take that group to £1 billion worth of revenue, so some very exciting times ahead. But there's an example of how a joint venture was created, and very quickly we've built a £100 million group.
Yep. And there's also many skill sets that come not only post acquisition, but if you're looking to build a group, there's like a different skill set that goes into actually building a group, because you've got to build the executive management, you've got to rearrange maybe cross-company guarantees within the group. So there's a lot of new learnings that come out of buying not only the first company, but the subsequent companies that could be of real help.
This isn't meant to sound arrogant, but actually finding deals, doing deals is actually reasonably straightforward. It's just a process. You've got a market to find the deal. It's a sales process to convince a business owner to sell to you. It's then a process of getting the legals, the funding, the due diligence all completed. The hard work for me really starts when you actually own the business, because it's then about how do you drive the synergies, particularly if you're buying a group. If you buy 4 companies, they're all going to have different processes, different cultures, and maybe even different funding arrangements. So it's about trying to integrate those businesses together. I'm a strong believer that we want to keep everything independent. So every business should run independent of the other, and we don't want to create some corporate Goliath where everything's centralized. It's all about trying to empower those businesses to become bigger and better. So looking for cross-selling opportunities. Good example, we're in the caravan and motorhome space, and a couple of the businesses that we bought are very, very good at marketing and social media, and some of the businesses that we bought, actually that's not their skill set. They're good at other things. But if you can take the good bits out of those businesses, share them with the other ones, then you can create those synergies and drive that value for everybody.
Yeah, totally agree. And then, I think there's a lot of skill sets and a lot of detail that goes into obviously every single aspect of the process that we've talked through. This is an A to Z on how to do a leverage buyout, but every single component has 20 different components to it, which comes out of just doing deals and going through the process every single time. This is ideal if you're looking to buy a business and you want to partner with someone that's gone through the process more than 97 times now, hopefully 100 by the time someone looks at this video.
We're always open to working with like-minded people. So if there's anybody listening that would love to joint venture with us and seize an opportunity, then do get in touch. But we hope you found our episode today useful, learning all about things leverage buyout, and we look forward to seeing you on the next episode.
Thanks, guys.
Thank you for tuning into our podcast today. Have you tried our free survey to assess your skills as a deal maker? Visit www.buybuildsell.net/survey to take our free survey and assess your skills as a deal maker.